Hello future investors, and welcome back to the channel. With everything that's been going on in this past year in the investing landscape, the GameStop fiasco, the rise and fall of cryptocurrencies like Bitcoin and Dogecoin, Elon Musk pumping the altcoins, there's been such a high interest for people to want to participate and understand this entire investing world. So on that note, today's video is going to channel that itch to get started as we learn all about the stock market and how to invest for beginners. Now, I'm going to assume that you know next to nothing about how the stock market functions. Practically speaking, the majority of people out there don't. So first of all, props to you for being even willing to learn new information and being open to watching this video. I decided to break this video down really into 10 different sections, 10 different chapters as we're going to call them. Each of them is going to discuss a different aspect of the stock market. And then at the very end of this video, we're going to execute a real live trade, meaning we'll actually buy a stock. So make sure you stay tuned to see me take what we learn and actually apply it in practice. Now, we're not going to be covering everything that has to do with the stock market. A lot of concepts like growth stocks, value stocks, things like options trading. You may have heard of some of these before. They really just deserve their own separate video to give these topics their due diligence in understanding them. So I want to be careful not to overload you with too much information in this video. I'll try to make it as practical as possible, and my goal here is just to give you a framework for getting started in understanding how to invest in the stock market. I promise you it is not as complicated or as daunting as it's often made out to be. You don't have to be a genius to get started. So be sure also to check out some of the links down below this video. I've linked a couple different stock brokerages and other helpful learning resources, a couple of books, and other videos here on YouTube that have been immensely helpful to me in understanding the basics and some of the things we're not going to be covering in today's video. So leave a like down below if you enjoy this information, and without further ado, let's get started. Chapter 1, Investing Prerequisites. Now, before we go any further, there are a few general investing disclaimers, if you will, that I feel it my duty to share. Number one, you've heard it before, you're going to hear it from me. Don't invest more than you can afford to lose. Ultimately, as we're going to find out, investing in the stock market, it's a little bit of a play on the future. And the future, as we all know, is very, very unpredictable. So always be prepared in any situation for your investments to go south. If you do your due diligence in researching and you're careful, that's likely not going to happen, but you never know. Hope for the best, prepare for the worst, right? Secondly, don't invest in something that you simply don't understand. Now, in today's video, I'm going to be mentioning certain stocks, some that I'm very, very passionate about. I am not a financial advisor. Never take investing action based on what I say, or for that matter, anyone else on the internet. You can certainly entertain their opinions and hear them out on their 2 cents. That's totally fine. But ultimately, before you pull the trigger and make any investing action, make sure you fully understand what you're investing in. Do your own research. Don't impulse buy because others advocate a great opportunity, or because of FOMO, fear of missing out. Make sure that you have conviction yourself that something is worth investing into. Lastly, I would highly recommend paper trading first before you start investing your real dollars into the stock market. Paper trading, it's super cool. It's where you use a stock market simulator that often mirrors the real market. It allows you to trade with fake dollars to gain experience, so you're not putting your money out there without any knowledge of what you're doing whatsoever. And this is something that I did when I was just getting started. It's super helpful if you're brand new to investing in the stock market. And I'm actually going to link some of the more popular paper trading platforms down below this video, so make sure you do check out those links in the description. Chapter 2, Stocks Explained and Definitions. All right, you're still with me. Excellent. So we're going to start by asking the age-old question, what is a stock? We're going to keep this very simple. In its most basic sense, a stock is part ownership of a company. So let's take it to a company like Tesla, for example. Tesla is an electric car company. This circle right here represents 100% ownership of the Tesla Motor Company. By issuing stocks to the public, you and I, Tesla is, in a sense, splitting up ownership of its company. If you buy a stock, you are indeed becoming part owner of Tesla. Now, stocks are also often referred to as shares or securities. One share of Tesla, Tesla security, Tesla stock. They're used pretty interchangeably, and for the purpose of this video, they're virtually one and the same thing. And stocks can range from as much as thousands of dollars per one single share to as little as simply a few cents for a share. And those dirt cheap stocks are generally referred to as penny stocks. Now, a question you're probably wondering at this point, and a really great question, is why do companies even offer stocks in the first place? Well, more often than not, it is a way to fund their business. If a company is expanding rapidly, it's growing quickly, it needs money, it needs capital, often fairly quickly as well. And sure, it can choose to borrow that money from a bank or a venture capitalist, some kind of private investor, or it can choose to sell part of the business to the public, to investors like you and I, and use that money to actually fund its growth. And when a company decides to do this, when they issue stock and issue shares to the public for the very first time, this is referred to as a company's IPO. IPO, that's another important term we're going to learn in today's video. You'll hear me reference that throughout. IPO stands for initial public offering. And again, the initial public offering, or the IPO, is when a company issues shares and stock to the public for the very first time. So when you hear something like Coinbase just IPO'd, which actually did happen a few months ago, that means that Coinbase, which is a cryptocurrency company, is now officially a public company, and you can go on the stock market, they're listed there, and you can buy Coinbase stock. Make sense? Now, under that umbrella of stock, you actually have many different categories of stock. You've got value stocks, cyclical stocks, growth stocks, blue chip stocks, and there's many others. Most of these we're not going to be discussing in today's video, but there are two that I feel are important to understand going forward, and that's common stock and preferred stock. So common stock is by far the most popular kind of stock, and it's generally what people refer to when they say, I'm investing in the stock market. It's what I have. It's the most basic form of ownership of a corporation. And like we talked about earlier, since by owning stock, you are in a sense a small owner of a company, those with common stock can actually vote on things like who is elected to a company's board of directors. Now, obviously, as you might imagine, you'll need to have quite a hefty amount of shares in order to have any real decision-making power, but nonetheless, there is power in ownership. You've likely heard of the phrase shareholder meetings. These are meetings that are held to give shareholders the chance to vote on things like company issues or who's elected to a company's particular board of directors. So the big kicker here, the main takeaway with common stock is that common stock, it gives you voting rights. Now, preferred stock, on the other hand, does not give you voting rights, but what it does give you is what's known as a fixed dividend. Now, a dividend, also known as a dividend yield, simply put, at its most basic level, is money that you get for simply owning a stock. If a company is doing really, really well, like, let's take another automotive company like Ford, for example. Instead of reinvesting all of their profits back into the business, they might choose to take a portion of that and actually give it out to us, the shareholders, as kind of this token of appreciation for owning Ford stock. A lot of companies do this. This is, again, what's known as a dividend yield. And the best way to think about this is it's really a form of a thank you, or like we talked about, a token of appreciation for simply owning their stock and investing into that company. Usually dividends are paid out at the end of the year. Sometimes it's quarterly, sometimes it's monthly. It really just depends on the company and what they have to offer. Now, offering dividends, as you might imagine, is actually inherently a little risky on the company side, because once they start paying out dividends to investors, there's kind of a point of no return, and it's difficult to go back. We get used to that extra money, and if we receive less than normal, it's oftentimes in the market interpreted as a negative signal. Oh no, the company's not doing well, and that can directly impact stock prices. Now, I do want to mention for clarity's sake that you actually can have dividends with common stock like we talked about earlier. The catch is that it's never guaranteed, versus with preferred stock, like we talked about, it is a fixed dividend. It is guaranteed, and you're always going to be paid first when it comes to a company paying out to investors. Make sense? Awesome. So let's go ahead and move on to the next chapter. Chapter 3, Stock Brokerages, Where to Buy Stocks. All right, so now that we have somewhat of a basic understanding of what a stock is, now we ask the question, how do you buy a stock? Or more importantly, where do you even buy a stock in the first place? Well, for starters, you're going to need what's known as a brokerage account. There are dozens of brokerages out there. Some of the more popular ones include TD Ameritrade, Robinhood, WEBULL, Vanguard, Fidelity, M1 Finance. I've actually, on all separate occasions, utilized every single one of these except for Vanguard. And if you were to ask me, my two favorite and the ones that I use for buying stocks are M1 Finance and WEBULL. WEBULL, I just love the user interface of the app with all the different graphs and charts. I mean, you're never short for tools for analysis. And then I just love the simplicity of M1 Finance. They have a really, really cool structure where you can actually create a pie and allocate a certain amount of money to different stocks based on percentages that you dial in. So for example, if I next week decide to put $100 into M1 Finance, I could set it to devote 10% of that to Tesla, 50% of that to Walmart, 30% to Ford, and so on. I'm going to link all these brokerages down below if you want to research them, follow up, check them out, and make sure you do stay tuned until the end of this video because, like I mentioned earlier, we're going to execute a real-life trade on WEBULL, and you can actually see what that process of buying a stock looks like as a tutorial section of this video. Now, if you are interested in getting started with WEBULL, there is a link down below where you can get 2 free stocks valued up to $1,850 if you deposit just $100 into your WEBULL account. And if you want to get started with Robinhood, both of these are great beginner options. There is a link down there for Robinhood where you can get 1 free stock, so check that out down below. Chapter 4, Stock Market Vocabulary. All right, so in the stock market, you're going to hear a lot of terminology that's going to be repeated often. Things like volatility, liquidity, ticker symbol, bearish, bullish. It sounds Greek, I know, and a lot of it is actually, you'd be surprised. And so I want to take a few moments here and just really make sure we understand some of these terms going forward. Let's start with the question, what is a bond? You hear people buying up bonds. Your grandparents own bonds, your parents own bonds. What is a bond? Well, when a company or a government needs to raise money, what they do is they issue bonds. And in its most basic sense, it is a loan, an IOU, from you to the company or the government. For example, let's just say Microsoft issues a bond and the bond costs $50. They give you the bond, a piece of paper, so to speak, and they say, we're going to give you your $50 back sometime in the near future, plus some interest for trusting us in the first place. It's very, very simple. It's just like taking out a loan from a bank in many respects. You pay interest on borrowing that money in the first place. Companies usually issue bonds to raise capital or raise money in the short term. So that's what a bond is. Now, liquidity is another topic we're going to break down really quickly. And liquidity refers to how quickly a stock can be bought or sold without impacting the stock price in any significant way. So stocks that have very, very low liquidity are generally very, very difficult to get rid of or sell, and you may actually take a significant loss if you want to sell it or buy it quickly. You may have to lower that price if no one's willing to buy it for the price it's at. Think about selling a house. Let me ask you this. Do houses have low or high liquidity? Well, generally speaking, unless the market is booming like it is now, houses, generally speaking, have very, very low liquidity because it can often take months to find a buyer for your house and actually get it off your hands. Next, we have the concepts bear and bull. Now, a great way to visualize these is to think about the animals, a bear and a bull, and these represent conditions of the stock market. You may have heard these terms, a bear market, a bull market, thrown around on the news or in different conversations.
That closed, the S&P 500 falling into bear market territory, officially now down 20%.
I'm not buying that this is the end of the bull market.
A bull market is a time of rising stock prices. Things are increasing usually by a minimum of around 20%. You can think of a bull charging upwards on a hill. It's a really good time for the economy. There's usually a lot of employment, a lot of optimism in general in a bull market. In contrast, you have a bear market, which is the opposite. Stock prices are falling, usually by 20% as well. There's a lot of uncertainty, fear, doubt, pessimism. Usually it's followed by a lot of unemployment. You can think of a bear charging toward you, swiping its claws at you in a downward motion. It's bad. It's something to be avoided. And so you'll hear people talking about how bullish they are on a certain stock. It means that they believe that stock has a lot of upside potential. If, for example, you are bearish on Apple stock, it means you, generally speaking, don't hold a lot of optimism for that company in particular. Next, I want to touch upon very briefly the topic of volatility. Volatility is probably already a term or a concept maybe you're already familiar with. Volatility refers to how quickly a stock price fluctuates within a certain period of time. A stock that is high, low, up, down, over and over again versus a stock that is more stable, that second stock is going to have very low volatility. A stock with high volatility, like we just mentioned, is going to be up, down, over and over again. $50, $60, $30, $10, over and over again. And that spectrum and those dramatic changes in price generally are reflective of high volatility. The last terminology I want to discuss is what's known as the ticker symbol. This is a really important one to understand. You're going to hear this a lot when it comes to the stock market. The ticker symbol, or ticker for short, is simply a small group of letters that represents a particular stock as it is listed on the stock market. For example, Apple has the ticker symbol APPL, Tesla has the ticker symbol TSLA, Facebook is FB, Ford is just F. Usually it's a group of letters shorter than 4 or less. And if you want to find a company's ticker symbol, just search that company up on Google followed by ticker symbol or ticker, and you'll find it with ease. Chapter 5, Basic Investing Strategies. All right, so with the definitions and stock jargon behind us, let's go ahead and move our discussion to talking about stock strategies. Now, there are a lot, and I repeat, a lot of different ways that you can go about trading stocks, researching which companies to invest in, but there are a few that I do want to highlight today that I think are really, really good to keep in mind if you are a beginner. The most basic way of investing with stocks is to buy low and sell high. Buy a stock when it is lower in price and sell it when it appreciates in value, and obviously you get to pocket the difference. So let's take a look at a practical example of what I could have done. This is not something I did execute on, but this is the month of July, and if we actually pull up Apple stock on Google, we can see that if we would have purchased one share of Apple around June 25th, which was roughly a little less than a month ago, when one share of Apple was priced at $133.11, we could have sold it today, honestly, for when Apple is priced at $146.39, and would have pocketed the difference, which is obviously a little bit more than $10 there. So that's pretty much the most basic way of investing into the stock market. You buy low, you sell high. Chances are, if you are a beginner, you don't want your assets or your stocks to depreciate in value, kind of like driving a new car off an auto dealership lot for the first time. Am I right? But another way that you can invest in the stock market that's more short-term is through what's known as day trading. Day trading is where you buy a stock and you're looking to sell it minutes, if not seconds. If it increases by a marginal percentage, you're not worried about holding that stock long-term, like we talked about with the Apple example just a few minutes ago, with holding that for about a month's time and then turning a profit of a little bit more than $10. Day trading is very, very quick. You sell it, you take your profits, and you're done. And I know there's going to be day traders running ads for their programs and their updates on this video. So if this next ad that you're about to watch happens to be in that category, please avoid them like the plague. So that's day trading. Next, we have swing trading, which is very, very similar to day trading, except you're not looking to buy and then sell minutes or seconds after. It's more of a few days to about a week. It's still pretty short term in comparison to holding something for years and years, which we'll talk about momentarily. But swing trading, generally the activity of buying and selling is pretty much condensed to a timeline of about a few days. Next, after swing trading, we have what's known as buying and holding. Buying and holding is pretty much the most extended version of buying a stock, and you're in it for the long game. You are holding that stock for as long as you possibly can, months, years, if not decades, before you're actually willing to let go and sell. You've got diamond hands, as they say, because you have high conviction that that company is going to do well over the long term, regardless of the ups and downs, the peaks and troughs, which a lot of people do sell at those lows out of panic. They give in to all the FUD, the fear, uncertainty, and doubt. And that's why it often takes removing yourself from the emotional involvement of the stock market and having a lot of self-discipline to buy a stock and hold it for the long term in the first place. Another strategy is to do what's called short selling. Up until this point, all these stock strategies that we've talked about are based upon you making money because the stock appreciates. It increases in value. It goes from $13 to $17 or $200 to $1,000, for example. But short selling is the opposite. It's the opposite of buying low and selling high. In short selling, you're actually betting on the price of the stock decreasing and going down. Short selling is a fairly simple concept to understand. The entire idea of short selling is you borrowing a stock from a lender. You take that stock and let's just say you sell it at $40 to someone, and then you buy back that stock when the stock is at a lower price, hypothetically $30. The stock is at $30. You take that, you pocket that difference of 10, 40 minus 30 is 10, and then you return that stock to the original lender you borrowed it from in the first place, and you're left with that profit of $10. If that was a little bit confusing, press the J key on your keyboard and you can rewind 15 seconds and hear all that again. But the basic takeaway from this is that short selling is you betting on the stock decreasing in value. You sell it high, you buy it back when it's low, and you pocket that difference. The last important stock strategy that I do want to touch upon is what's known as diversification. And diversification is basically just a fancy way of saying don't put all your eggs in one basket. For example, hypothetically, if your entire investing stock portfolio is made up of Apple stock and Tim Cook, the Apple CEO, has a massive scandal next month and Apple stock prices plummet, well, your entire portfolio is going to be down in the dumps. And so it's always good to protect against risk and make sure that you actually are diversifying your investments in a variety of different categories in the stock market and not just in one company. Chapter 6, Stock Market Sectors. So this is a really, really simple section to understand, probably the easiest chapter in this entire video. And as you might imagine, we've hinted upon this so far in our discussion, but the stock market is not this random array and shotgun blast of different companies and different businesses to invest in. There's actually behind the scenes a lot of order and there's a lot of structure. And so that's what I want to talk about in this particular chapter, and we'll touch upon this a little bit later as well. So in general, there are 11 different sectors in the stock market that you can invest into. These are categories of companies, if you will. Number one, we have energy, and a great example of this is the company Shell. We have materials, a company example is International Paper, industrials like Caterpillar, consumer discretionary like Amazon, consumer staples like Coca-Cola, healthcare, Pfizer or Johnson & Johnson, financials like Goldman Sachs, information technology like Salesforce, telecommunication services like Verizon or T-Mobile, utilities like NextEra. Lastly, we have real estate like the Simon Property Group. So again, those are the 11 different categories that are comprised of hundreds and sometimes thousands of businesses. And it's always a good idea, as we talked about with diversification, to make sure that you've allocated capital to different categories so that if banking doesn't do really well, it has a really, really bad quarter, or 2022 is maybe not the best season for banking, you've got some money in consumer discretionary, you've got to play on technology. And so you're well balanced, you're mitigating against risk, you're hedging your bets. But things actually get a little bit more structured than this, and that's what I want to talk about in our next chapter, which we're going to talk about index funds and ETFs. Chapter 7, index funds, mutual funds, and ETFs. So we've talked about investing in individual stocks. We've talked about the difference between common stock and preferred stock. We've covered the different sectors of the stock market. Thank you so much for staying tuned so far. I now want to talk about and lay the grounds with an important question. Is it possible to say, take individual stocks and group them together and invest into that collection as a whole? Yes, it is. This actually brings up a really important concept in the stock market, and that's what is known as a stock index. A lot of these stock indexes you may have heard before: the S&P 500, NASDAQ, the Dow Jones Industrial Average. A lot of these may ring a bell. What they are is a grouping of stocks. It's a list. The S&P 500 is a list of the top 500 companies in America. The Dow Jones, or the Dow Jones Industrial Average, as it's formerly known as, is another grouping, another index, another list of 30 companies. Now, as you might imagine, it's rather difficult to buy into and invest into one of these entire stock indexes, because to invest into, let's just say, the S&P 500 is going to require an investment upwards of tens of thousands of dollars to buy one share of every single company. Amazon is part of the S&P 500, and to buy just one share of Amazon alone is going to cost you upwards of $3,500, at least at the time of filming this video. So as an alternative, you can actually choose to invest into, and this is what I do, what's known as an ETF. An ETF stands for an exchange-traded fund, and all it does is it copies one of those indexes that we talked about, like the S&P 500, and it mirrors its movement. So for example, the Vanguard S&P 500 ETF, which has the ticker symbol, which is a word we learned earlier, it has the ticker symbol VOO. As you might imagine, that Vanguard S&P 500 ETF, it tracks the S&P 500. And just like stocks, you can actually buy shares of these ETFs, which allow you to invest $100 or $1,000 into hundreds, if not thousands, of these companies without having to buy all these shares individually. So what an ETF does is it allows you to really diversify your portfolio across multiple companies and creates a very, very low barrier of entry. Lastly, I want to touch upon mutual funds. Mutual funds, you may have heard of these before. They are very similar to ETFs. In fact, in principle, they're basically the same thing. Just like ETFs, they are a basket, a collection of stocks, a pool of different investments. One of the main differences, though, is that with mutual funds versus ETFs, mutual funds usually have some kind of an investment team or a portfolio manager behind them that is actively managing the fund. These investment people, they're looking to improve the mutual fund, and because of how hands-on they are in researching and sometimes removing companies because maybe a mutual fund is too heavily concentrated on Apple stock or has too big of a portfolio concentration on Tesla, for example, you are paying for that involvement. And that fee that you pay for someone who's managing your mutual fund is what's known as the MER, or the management expense ratio. So just to recap this chapter, ETFs, generally speaking, are passive investments. There are a few exceptions, but generally what they do is simply just track an index like the S&P 500, like we mentioned from previous, versus mutual funds, which are actively managed. There is a team behind them that are doing research, and thus they're usually a little bit more expensive to invest into. Chapter 8, passive versus active investing. So hopefully you're tracking so far. I want to thank you for staying tuned to this portion of the video. This is really the fun part. We've covered a lot of the complicated terminology and stock market jargon and different concepts that kind of go over people's heads. So if you're tracking, props to you. Now is the time where we can actually start thinking about what kind of an investor we actually want to be. At its most basic level, you really have two different choices at your disposal. You can be an active investor or a passive investor. A passive investor is someone who really doesn't have a whole lot of time to devote toward researching companies and keeping up to date with all their latest quarterly reports and financials. If that's you and you're someone who's pressed for time, it might make more sense to invest into something like a blue chip growth fund, which is a mutual fund, like we discussed earlier, made up of blue chip companies. And blue chip companies are companies that have great reputations and generally stable earnings. So just to give you a list of some blue chip companies: Berkshire Hathaway, Walmart, AT&T, Target, PepsiCo. Investing into a blue chip growth fund was actually one of my first investments that I made back in early 2017. I used the investment management company T. Rowe Price and actually bought into several blue chip growth funds, which I think we'll cover in a later video. But in general, all of that's passive investing. Now, on the other hand, if you want to be active, you want to be an active investor, you want to be involved in the market, researching in the trenches, learning new information, it might make sense to start investing into stock from companies that you already have somewhat of a natural interest in. What companies, what brands are out there that you feel that you have, somewhat significantly have a finger on the pulse of? The products that you make use of on a daily basis in the kitchen, on the road, at work, or at home. Ask the question, who manufactures them? For example, I'll give you a great illustration. I'm an Apple user. I mean, I've had the Mac Air for a while. I've got the MacBook Pro. I've got the iPhone. And so it makes sense for me to actually invest into Apple stock because I am a consumer of their products. If you are a diehard driver of a certain car manufacturer, Ford or Tesla, you may consider buying stock of those companies because you are already somewhat familiar with what's going on with your investments. After all, you are a consumer. As an active investor, you're going to be staying on top of that company pretty diligently and religiously, or companies, depending on how many you are investing into. You'll be looking into things like market trends, different economic or political shifts that could affect the company, even looking into what the press says about Amazon, for example. Whether or not society views that company in a negative or positive light can seriously influence investor decisions. So that's one thing to keep in mind as an active investor, is you're going to have a lot more awareness where a company is headed, or as far as its trajectory is concerned, if that is something that you think has upside potential, and maybe in the near future you see that stock actually soaring, and that maybe it's a good time right now to buy into that company, versus maybe the company doesn't hold a lot of optimism the more you look into it, and maybe that's a stock you want to start short selling or hedging your bets against. Chapter 9, Company Analysis and Research. All right, so let's just say you're interested in investing into a certain company. Maybe you pick a stock like Adobe, for example. Adobe is a computer software company. I'm an avid consumer of all Adobe products. In fact, future Joseph editing this video is editing this video in Adobe Premiere Pro. But at its most basic level, how do you go about researching a company like Adobe, for example, in order to help you make a decision whether or not that's a company you might potentially want to invest in? Well, at its most basic level, there are really two different methods of research, or different ways to analyze a company. Two different pairs of glasses, if you will, that you can put on, that you can view a company through. And those are fundamental analysis and technical analysis. Fundamental analysis is all about looking at the value of a company or a particular stock. And there's really two different ways in which fundamental analysis can be broken into. Number one is through what's known as quantitative analysis. And quantitative analysis, as you might have guessed, is all about quantity. It's all about the numbers. This is by looking at things like a company's revenue, their projections, their potential earnings in a new quarter, their liabilities, or any assets that they have on their balance sheet. It's all the raw data. And we're actually going to do a little bit of quantitative analysis here in just a second with Adobe. I want to illustrate kind of what this looks like in a very, very simple format. Number two, the second half of fundamental analysis is what's known as qualitative analysis. And qualitative analysis is all about looking at the aspects of the company that cannot be measured in numbers. We're talking about things like the management of a company or its brand recognition. For example, think of a company like Coca-Cola. A lot of people will immediately visualize in their minds that red circle logo with the white cursive on it, but others Others will have a flood of nostalgia that comes to them every time they see an ad in which someone is happy and joyful, energetic, drinking that bottled, bubbly beverage. And that's all because of the brand recognition that Coca-Cola has and how established the corporation is. And that's something that you can't put on a notepad. It's something that cannot be measured in numbers. So that's fundamental analysis. And fundamental analysis, again, is made up of that package of quantitative analysis, which is looking at numbers of a company, and qualitative analysis, which is by looking at things that cannot be quantified in numbers. Now, on the other end, we have what's known as technical analysis. And technical analysis, as the name implies, is very, very technical. Technical analysis is all about using the stock charts of a company. You're doing a lot of graphing. You're looking at the green and red, the candlesticks, the ups and downs, and you're looking for patterns in the price trajectory of a certain stock that you might be able to predict and leverage to help you make profitable investing decisions. Technical analysis is used very, very heavily by day traders and swing traders, which, if you recall back to our discussion that we had about these two investing strategies in Chapter 5, these are investing strategies that are looking for those quick profits. They're buying, they're selling fairly quickly, often within a few days. And so day traders or swing traders aren't too concerned about the long-term trajectory of a company. They're not looking at the quantitative analysis like a company's profitability or the qualitative analysis by looking at company culture, for example. They're making a lot of their day-to-day decisions based on the stock charts because they are after those quick profits. All right, so with all that in mind, I want to do a little bit of fundamental analysis. This is going to be a very short section of this video, but I think it'll be highly informative for you because we've hinted at things like company financial statements, looking at company earnings, projections, revenue, and things like that. Where can you even find all of this information online? Well, I want to take a look at Adobe. We're kind of on a roll with that company, so we'll use that as an example here. Most companies are going to have what's known as an investor relations page. And the investor relations page usually is a subsection of their main website, in this case, adobe.com. And it's a section where you can learn all about things like earnings, their annual reports, quarterly updates, etc. So to find the investor relations page, normally what I do is simply Google the company name, followed by investor relations, and it should bring it up usually in one of the first results. If we wanted to do this with another company like Walmart, for example, we can type in Walmart, investor relations, and it should come up as well as the top result. All right, so if we go back to Adobe here and we go ahead and click on the investor relations tab, we'll scroll down to the bottom here, and there's a few different hyperlinks we can click on, but I want to draw your attention to this quick link section. And there's a few different staple documents that you're always going to see on these investor relations tabs, whether we're looking at the investor relations page of Adobe or Walmart or Amazon. And I want to go through some of these, but I really want to draw your attention to one particular hyperlink here, and that is this one, the earnings call script and slides. This is not something that every company does. Adobe does it, but sometimes as a potential shareholder, as a potential investor, you can actually listen into some conference calls that these companies have in which they're discussing different topics. And this actually gives you the transcript and slides of certain calls. So these are things that not everyone taps into, but if you're really, really hyper vigilant and you're wanting to stay in tune with where a company is in the market, what's going on internally, these are things that can really, really help you in your decision to invest in that company or the lack thereof if maybe you don't see it as a good opportunity in the market right now. Next, I want to draw your attention to what's known as the Form 10K. And the Form 10K is required by every company. It's something that is required by the SEC, the Securities and Exchange Commission, and it gives an overview of a company, or in this case Adobe's financial performance in this past year of 2020. It's 2021 now, so this is their Form 10K for 2020. So if we go ahead and click on this document, we'll open it up here. Please do not be overwhelmed and see this as very, very daunting with 117 plus pages here. It's just like when you're using a piece of software for the first time, or you're playing a video game for the very first time. It's overwhelming. It's a world you have to learn, and only by getting familiar with the user interface, or in this case, the structure of this document, are you going to learn to weed out certain sections, and you'll know what to pay attention to. You'll know where the best use of your eyeballs is in reading this document. So I would highly encourage you, even if you've got a few companies you want to invest in, just read through this. You don't have to read through the entire thing, but skim read it and get a bearing for the structure of this document. And by no means have I claimed to master this in any way, but by going through dozens, if not hundreds of these by this point, I do have a good sense of where the most important sections are. What am I going to be paying attention to? So I would encourage you, if you get some spare time, just go through and look at the table of contents for some of these companies and really just get a sense for how these documents are laid out. The benefit of reading through something like the Form 10K, which again is simply just an annual financial report that a company has to file. This was Adobe's for the year of 2020. it's really going to give you a solid grasp on the company's financial past, and that can either solidify or present uncertainty that's going to aid you in making investing decisions, whether you want to put more money into this company because you like what you're seeing or you don't like what you see and you want to hold back your money until a better time for this company. So that's the Form 10K. If we go back to the investor relations page, I want to take a look at one more form, and that's what's known as the Form 10Q. Now, this does not come annually. This comes quarterly. And it's very, very similar to the 10K. It's not as long. It's about half the length. But what it does give you is quarterly updates on a company's financial statements, management discussion, and other forms of analysis. For example, you can see here's quantitative and qualitative disclosures about market risk. We kind of touched upon those topics very, very briefly. So this is also a good read as well. It's not annual like the 10K is, but it is a periodic update that gives you, a good representation of the status quo that a company is in currently. Now, I know this is a lot of information. I'm not going to lie, but I can promise you as you read through some of these reports, you are going to get a much better understanding of how these are structured and what to look for, what to skim over. I'm still learning as well, but I can tell you with certainty that I have a much better understanding of how to read these than I did 2 years ago, simply by just going through the volume of these reports. And so don't worry about understanding every nuance of the 10K and the 10Q right now. It is an entirely new world to you. I understand it. It can be a little bit overwhelming, but just realize that practice makes progress. I do want to mention too that Yahoo Finance is such an incredible, invaluable resource for looking into the current status of a company and all of its updated analytics. We'll cover all these metrics right here in a later video: the earnings per share, beta, which has to do with the volatility of a stock, a price to earnings ratio, or what's known as the PE ratio. All this has to do with really how you value a company, and I could really spend an entire another hour just breaking all this down in detail. So subscribe to this channel if you want to see me cover these in maybe a later video. You'll actually recognize a lot of these keywords that we discussed already, like here's dividend yield, for example. We covered that in a previous chapter. If you ask me, I also like looking at Market Watch in addition to Yahoo Finance. A lot of these outlets, they cover a lot of the same basis points, but some of them also have the SEC filings that we referenced from Adobe's investor relations page, the Form 10K and the Form 10Q. So it just, depending on what you use, it just makes the flow of research a little bit easier. Okay, so we did some research on Adobe. We're an avid user of their products. Maybe we did some research and decide they have some incredible upside potential. I believe they do have a lot of potential. In fact, I'm already invested in Adobe, not financial advice. But regardless, how do we actually buy a stock from a company? What does that process actually look like? And that's what I want to focus on in this next chapter, the final chapter, as we use the WEBULL mobile app and actually execute a live trade. Chapter 10, Market Hours and Live Trading. All right, so you made it to chapter 10, the final section here, where we're actually going to execute a live trade on WEBULL, and I'll show you from start to finish what that process actually looks like. This is a chapter I've been looking forward to filming for quite some time. You may notice things are a little bit different. I'm wearing a different shirt here. The lighting's a bit different because I'm filming this during the day. I normally film these stock videos at night. The reason why I mention this is because of market hours. There's a certain window in which the stock market is open and you can buy and sell stocks. You cannot do it whenever you want, just like certain restaurant chains or grocery stores. You can't go to the grocery store in the middle of the night unless they provide 24/7 service and simply buy whatever you want. There's a certain allotted time frame in which you can actually conduct business. So these market hours, as they're known as, is the window in which the stock market is open, and it ranges from 9:30 a.m. to 4 p.m. Eastern Standard Time, which I believe Pacific Standard Time, that would be 6 a.m. to 1 p.m., which is actually the time zone that I'm in. And so I'm filming this roughly around 12 o'clock, so we got about an hour before the market closes. Now, depending on which brokerage you use, for example, we're going to be using WEBULL as the brokerage to actually perform and execute a live trade on. Certain brokerages will actually give you pre-market hours or extended hours. So we kind of have that default time frame of 9:30 a.m. Eastern Standard to 4 p.m. Eastern Standard. WEBULL actually gives you an additional 3.5 hours in the morning, all the way up until 4 a.m., which is known as the pre-market hours, where you can begin trading. And then they also give you additional 4 hours on the back end, all the way to 8 p.m., where you can still access the market and lock in certain buys or sells. Most brokerages have different pre-market or extended hours. Some don't offer them at all. I know WEBULL is generally the most preferred brokerage when it comes to these pre-market and extended hours, simply because it has the widest spectrum. Robinhood is also another one of those beginner brokerages as well. Robinhood, I believe, only adds a half hour in the morning and then a couple of hours in the the evening all the way to 6 p.m. if I remember correctly. So it's a little bit better than standard market hours, but it's not too significant. Be sure to check the links down below this video for the specific brokerages that we've mentioned throughout this video and their particular extended and pre-market hours. It does differ depending on which brokerage you use. But with the understanding that the stock market is open Monday through Friday, except on holidays, and we have this window of time during the day in which we can actually execute a trade, let's go ahead and do just that. Let's pull up the WEBULL app, and I'll show you exactly how we can purchase a stock. All right, so upon opening the WEBULL app, we're immediately greeted by all these different graphs and icons. And as I mentioned previously, WEBULL is certainly one of the more visually challenging apps out there, but please do not be deterred by this whatsoever. I only prefer WEBULL, and I recommend WEBULL simply because it gives you more tools than you're going to need, and you can always appreciate that extra analytical insight when it comes to making investment decisions. So what I think we're going to do for this video is we're going to buy some Ford stock. Now Ford, if you remember from our previous chapter, has the ticker symbol simply F, and I actually have Ford here on my watch list. And a better way of finding Ford, if it's not on your watch list, or any stock for that matter, is simply going to the Markets tab at the very bottom, and then you can click the magnifying glass, the little search glass at the upper right-hand corner, and then you can go ahead and search the ticker symbol, or you can search the company name. So we'll just search F, it's the top result, and we can pull up Ford right here. Now you can see you've got a lot of different windows at your disposal. You've got the line graphs here, which you can actually change the timeline of. Right here at the bottom, you can select 1 day, 5 days, the price trajectory of a month, of 3 months, of 5 years, of maximum. If we go back to 1 day, if you go right here at the bottom right-hand corner, you can actually select the line type. So if you prefer to see the candlesticks, which a lot of people prefer, or if you want to see something maybe a little bit more graphically appealing, like this particular grayed out line graph, I prefer the line. It's just more simple and is more prone to my taste. But what we're going to do is, I wanted to select Ford in particular simply because it was a bit of a cheaper stock. And there's also the concept of fractional shares. Fractional shares is the idea that some of these huge market cap companies like Amazon or Tesla have a high barrier of entry simply because one share price will be up there around $600, $700. Amazon is up there at $3,500, which is a little bit daunting and kind of out of the ballpark for your average investor. They're not throwing $3,500 on one share of Amazon every single day. So fractional shares is the ability for you to purchase a percentage of one share of a company. So 50% of a share of Amazon will give you something around $1,750. Which is roughly half of $3,500. So fractional shares is something that Robinhood offers in particular. WEBULL also offers this as well, but I wanted to illustrate purchasing one share of a company, so I wanted to choose something that was rather cheap, hence Ford, which is at $13.93 right now, which is actually a relatively good time to buy because we've talked about earlier these different investment strategies, one of them being buy low, sell high. You can see the price trajectory graph of Ford right now is in the red. It's kind of a low day for this particular company, so it'd be it'd be better to buy right now than if it was massively in the green. So to go ahead and do that, you're going to click this little trade window, this trade icon at the bottom left-hand corner. But before we get to that, we're not going to go into all these different analytical insights right now, but you have a lot of different metrics at your disposal. You can actually look at the volume, which is right here in this time and sales window. You can see how much of the Ford stock is being traded. You can scroll down, you can see the order flow distribution, large scale orders in the last 5 days. A lot of these we're not going to go into because this is not a WEBULL app tutorial. I simply want to illustrate how you can purchase a trade, but I wanted to give you some user interface context here to help you understand where exactly I'm directing my attention and your focus. So let's go ahead and click at the bottom right-hand corner. We'll click the trade icon. We'll enter our trading password, which is something you'll have to set up if you sign up for WEBULL. It's going to pull up this trading window here, and you'll see a few different options at our disposal. It's going to feature the graph that we saw on the previous window right here at the bottom, or the top third. And we can see here for the side, we can choose to buy the stock or we can choose to sell it. I currently don't have any Ford stock on my WEBULL account. I do have someone at M1 Finance, so we don't have the option to sell right now. Now, order type. There's a couple of different options here. I want you to ignore all of these except for limit and market. A limit order, this is very important to understand. A limit order is if you want to buy Ford stock at a certain price, so you set the threshold. If Ford hits $12 per share, for example, then that's when you want your order to take effect. That's when you want to actually buy the stock. Market order is simply buying it at the price that it's listed right now for a quick and an immediate purchase. So if we're actually going to choose a market order because we're not going to wait around for this to execute and wait for Ford to drop to $12, which is not happening anytime soon. Well, then again, you can't predict the market, so there's always that. But let's go ahead and choose market, and you'll see here we actually have the option. Whoops, let me pull that window back up. Fractional shares trading enabled, which is something that we kind of talked about. With the market order, we can actually make use of fractional shares. So you can see that option right here under order type. We can buy a whole share or we can buy a fractional share. So just to illustrate what a fractional share would look like, we can actually hit the plus button, we can dial this up, and we can say buy 10% of a share, which is 0.1. We're not going to do that right now. We're just going to buy a whole share. We're going to buy one whole share. Next, under order type, we have the time in force. The time in force is how long you want your trade to be active before it actually expires. So for some stocks, not Ford. Ford is a decently high volume stock, but for certain stocks, there may be very few people actually selling, and so you may have to wait a while and actually order to buy a stock. And this time in force option is asking you, how long are you willing to wait? So if we click on that option, we can see the order will be canceled after the market closes on the day. I'm relatively certain that this order is probably going to go through within a few seconds. We're buying at the market order overall. We're not setting some unrealistic threshold for when we actually want the Ford price to drop or rise to. So we're just going to select day, which is the default option. We can see the estimated amount down here, $13.93. And then we can see a few other options that aren't super important. Day trades left 3. That's something that you're going to have just on a standard WEBULL account. You can upgrade that by adding more information, which we're not going to worry about right now. So let's go ahead and click buy. We're going to confirm all of this and wait for this order to be executed. All right, so the order went through as expected instantly. If we actually go back to the Ford stock page, we can click this little money icon at the bottom right-hand corner, and this is going to show us the positions that we currently have on Ford. So we see we have one share of Ford. The market value is $13.39, and it hasn't changed, so there's no fluctuations in price, which is decent for the time being, but we'll see how this develops over time. If we go back to the main navigation menu, we go to My Watch List, and then we can go ahead and click this WEBULL icon center at the bottom of the screen. This is going to take us to our position. So we can already see, you probably saw the flash of red there. That was the Ford stock dropping just a little bit. This is an account that I set up for the purpose of this video. I think in another video we'll actually break down one of the other accounts that I have on WEBULL, which actually has all my other positions in different stocks. But we can see here the only position we have here is simply Ford. If we click on that, it can show us exactly, see we've already dropped 1 cent there, 2 cents now. At the very bottom here, we have the option to buy more, or we can simply close, set what's known as a stop loss, which is basically if your losses fall beyond a certain threshold, you automatically sell. Even though you're losing, at least you're not going too deep into that pit, so to speak. You can also do the opposite, where if you reach a certain amount of profit, say $2 per share, you immediately sell because you're not willing to keep your chips in the game, so to speak, and go double or nothing and risk that stock actually dropping significantly in price. So I hope you enjoyed this tutorial. Please let me know if there's anything that I can clarify in the description down below based on this specific tutorial in Chapter 10, and let's keep an eye on that Ford stock. All right, you made it to the end of this video. First of all, I want to say props to you for being willing to watch this video in its full duration. The stock market is, in society, often presented to be much more daunting and complicated than it really is. So I hope it made it digestible for you in this video. And now you've got this knowledge and the skill set that you can go out and apply, or at least have a better awareness of what's going around you in the economy. And second of all, I want to say thank you for watching this video all the way through. I enjoyed putting this video together very much so. It's been about 4 days of filming, and I know it's going to be about a week of editing. So leave a like down below if you appreciate my efforts. If there's anything that I can clarify, anything that is unclear in your mind, leave a comment down below. I'll do my best to fill in some of the gray or blank areas that you may have. And additionally, check out the resources in the description down below. Like I mentioned previously, you can get 2 free stocks on WEBULL valued up to $1,850 if you deposit just $100 into your account. And there's also a link down below that can get you a free stock on Robinhood if you want to use that brokerage as your first beginner app. So thank you guys so much for watching. Feel free to subscribe down below for future financial related videos on this channel. And as always, we'll catch you guys in the next video. Take care. Cheers.